This is your Wall Street wake-up call. The economy adding 255,000 jobs in July, beating estimates of 185,000. Here with reaction now is John Lonski, the Chief Capital Markets Economist at Moody's Analytics. So John, a lot to discuss here. I actually want to start with the revisions to the past 2 months. May was revised higher from plus 11,000 jobs to plus 24,000. June was revised from 287,000 to 292,000. The past 3-month average of job growth is now at 190,000. So this really helping to smooth out the volatility we've seen in the past couple of months.
Yeah, this is a big upside surprise, both with a number for July, and the previous numbers for May and June.
And in terms of the labor force participation rate, that actually also inched higher to 62.8% from 62.7%, but the unemployment rate held steady at 4.9%.
Well, higher wages, I guess, are drawing more people into the labor market. If not higher wages, it's simply the need to get a job.
And we also saw wages up 2.6% over the past year, up 0.3% during the month. That beat estimates.
That did. As long as you have a tightening labor market, you're going to see upward pressure on wages.
But the question now is, for how long can we see job growth, north of 250,000, right? I mean, we're really going to have to see increases in corporate revenues, right?
Yeah, right. It's kind of funny because there's only one data point that argues for strong jobs growth, and that would be initial state jobless claims that are now at their lowest ratio compared to payrolls on record. To the contrary, we're talking about corporate revenue growth. It's been on the sluggish side. Even if we take out energy, it's running less than 3% year over year. Real GDP in the second quarter, up only 1.2% from the previous year. That was slower than payrolls growth of 1.8%. That brings attention to the lousy performance by productivity. How much longer can you have jobs outperform the overall economy? Well,
and the real question now is, to what extent does that matter for the Fed? Do they need to see job growth beyond 250,000 in order to raise rates in September or even December?
Well, the Fed's going to be looking at the global situation as well as what's going on in the United States. Right now, the market is not very much concerned about the nearness of a Fed rate hike. The probability assigned to an unchanged Fed funds rate at the December FOMC meeting dipped from roughly 62% to a recent 57%. And we find, again, the 10-year Treasury yield just over 1.5%.
But should they be more concerned? Because you look at these numbers and we were all worried about that May figure, and we've got yet more proof that that low May number was indeed a fluke. You look at these numbers and you say, well, how could the Fed not raise rates in September?
Well, in a way, it makes sense for them to go ahead and begin to normalize monetary policy. But the financial markets are not especially concerned about price inflation. We see that in the behavior of the Treasury bond market. It might very well be that the Fed is not going to hike rates until the Treasury bond market tells it to do so.
All right, and what do you think the market reaction will be to all this?
I think it's positive. We're seeing signs of a possible improvement, faster rate of growth for consumer spending, while at the same time, the Federal Reserve is in no rush to hike interest rates. This improves the outlook for corporate sales as well as profitability.
All right, we should point out we have one more jobs report before that September meeting for the Fed, so all issues we'll be watching. John Lonski from Moody's Analytics, thank you for joining us.
Thank you.
I'm Scott Gamm, and you're watching The Street.